Okay, let's talk about layering Confluence. Now, this is a really, really cool thing. And what I want you to understand about it, this is a recent trade that I just took this morning, captured live footage, put it on YouTube. Um, and this is just a perfect example of layering Confluence. Okay, so as you can see, the fibs are laid out right there. Now, I don't want you to think, oh, hey, you know, if we take the fibs and we roll them out and then it comes back to say 61.8, then we're good to take the trade or something like that. That's not what we're doing. So the way that you may have seen Fibonacci taught and things like that, hey, if price comes back to this point, then we're good to go. That's not what we're doing. We're still finding our key area. We're still dropping down and getting validation. But what the Fibonacci and some other things that I'm going to show you can act as is just an additional form of confirmation. So we're not banking on these things alone, but they can just kind of tell us, hey, is there maybe a little bit of extra oomph here? Is there a little bit of extra, maybe trampoline bounce that could happen right here? So all we're doing with the fibs is we're taking them from the low to the high of the move. So when the move happened, it would have looked something like this, okay? So price had a push, it broke a level, and then we're waiting for the retracement. And what we're kind of banking on, not hoping, what we're kind of banking on is that we find validation down at this area. And we can, by just taking the fibs and dragging them from the low to the high, we know that, and if you don't know this, 618 is a very, very common place for price to pull back. Usually, I'd say maybe more often than not, when price pulls back to this retracement level, which is about 61% from the top, then it's pulled back, then it usually finds a place where it picks up momentum and goes again. Now, it doesn't always happen like that. It can be the 786. If it's a full turnaround, then it'll just blow right through the fibs. Sometimes it's the 38.2, sometimes it's the 50, sometimes it's in between. And this one lines up really, really well. So if we want to put a little bit of confirmation, not confirmation, confluence, because really our confirmation and our validation is going into the 1 minute time frame and finding our candlestick entry pattern, really reading price and listening to price tell us, hey, listen, this is what we're doing at this moment. Okay, great. We're going to go ahead and follow along with what price is saying. But this can act as just a little bit more surety, a little bit more, okay, wow, this is great. Not only is price coming back to retrace at this level, but it's also coming back to this 618 level, which is, key. There's a bunch of traders who are called fib traders, and they'll just trade the fibs. They'll just trade when price comes back to a certain area, and they'll just go ahead and take the trade, or they won't take the trade. And so this is something that's valid. It is something that you can totally use. I don't use it on every trade. Actually, as a matter of fact, I mostly don't use it. Maybe I will start using it more. But it's just a nice reference point. That's really basically what it is. And so when you draw your fibs, make sure that it's clear. Make sure that it makes sense. So let's go ahead and find another example of where the fibs would possibly give us a little bit of validation. So right here, all we're doing is we had this high point, right? So we're just grabbing the pullback right here, which is the low, and then we're just dragging them to the high point. And again, we're kind of seeing, okay, where does this retracement line up with this potential area of support? So as you can see, it's the 50. Absolutely nothing wrong with that. If price still came back here and gave and price action told me, hey, listen, here's the candlestick pattern, let's go, I would still take this trade. But that doesn't mean that you have to, okay? If you find in your trading, because you're going to take this and you're going to be applying this in your trading all over the place, okay? It's going to be what you're going to do moving forward. So there's a lot of hands-on with this, man. This isn't the whole lesson where I show you the PowerPoint and shit and then you walk away and you're like, oh, okay. No, I show you all this stuff and you're going to take this, you're going to get your hands dirty. You're going to find stuff that really works for you, things that you're like, I don't really use that one as much. And you're really going to make it something special in your trading. You're going to get to identify things very, very clearly. And some things are just going to work really, really well for you. And other things you're going to be like, no, I don't really use that. And that is completely fine. That's actually what we're after. So if you want to, you can totally take the fibs, wait for somewhere around the 618, maybe here, maybe here, maybe here, to line up with a level of potential, in this case, support, and totally take that trade, man. There's absolutely nothing wrong with that. So right here, where is the pullback? So here we make a high point, price pulls back right here before it pushes up and breaks it. And where's our high point here before price starts pulling back? So our high point's right there. Okay. So this one kind of lines up around the 50 right there. And the reason why I kind of point to the 618 is because a lot of times that's just I mean, if you've been trading for any amount of time, then you've heard the 618 and probably the 786 referenced quite a bit. It's just because that's a great pullback spot for price, and a lot of times when price pulls back there, if it's going to continue to go up, it will often pull back to the 618. Okay, so let's jump over to another pair. Okay, and the only time that I want you to use the fibs is when it's obvious to you, okay? That's the only time that I want you to use the fibs. That's the only time that I want you to do anything, okay? Imagine how many trades you have lost and that you lose because you just didn't understand fully what you were looking at. You didn't understand the nuances. It was just kind of confusing. Maybe you thought you knew what you're looking at, but then after you enter the trade, you're like, oh God, why did I do this? So that's the kind of stuff that we're going to prevent. It's much better to just kick back until something is completely obvious. You don't have to play this game where it's like, oh, I don't know where to put my levels. I don't know where to put my fibs, that sort of a thing. If it's not obvious, you're not doing anything wrong. You just shouldn't be doing anything. You should just wait until it becomes more clear. You can see the contrast. You can see a pullback. You can see price break to a new level, that sort of a thing. So we're just going to plot this in. Okay, price breaks the level. Here's the pullback. Kind of consolidates around a little bit of movement there, finds a top before it pulls and then breaks to the next level. Oh, and look at this. It comes back to the 618. Okay, and so that's just a little bit of added confluence right there. Confluence is just giving us a little bit more surety, like on the trade, a little bit more of sort of like an edge. So with this one, the bottom is right here, but where exactly is the top? Well, we don't exactly know right now. Right now, the top is here. But if this does another push above, and it really, I mean, it hasn't really had any any real pullback go on. I mean, it had this candle right here, but other than that, it's just kind of been coasting off, into the upward sphere without any sort of real pullback action. So what we're going to do is, if this has a move up, well, we're just going to adjust our stop loss. We're just going to adjust our fibs. If it continues to just coast on right here, and then it has a pullback, and then it breaks this level, well, then we would grab the pullback, and then we would go to the top. What could happen right now, though, is that it now starts its downward momentum, and then this would be a potential area. And this actually lines up very, very well. I mean, actually, this lines up picture perfect, okay, with this area of potential support. It's been respected here, then it's been broken through. There could be a potential retest, and we've got the 618 running through. You see how this can kind of, if you can kind of line something up, it can just kind of give you that indication of like, okay, cool, right on. Like we're on point with what's going on here. Okay, so now that we've kind of gone through the fibs, you can go ahead and layer that if you want to. We're going to talk about EMAs. So there's a couple different EMAs right here that you can use, okay? And I want you to experiment with them. I want you to go on your own charts and just kind of see what you can put together with them. So one is the 200. So this EMA right here, and what the EMAs basically do is like the 200, for instance, it takes into account the last 200 candles on the chart. Okay, so in this instance, they're 15-minute candles. When we drop down to the 1, it's going to be 1-minute candles, and it can give you a general idea of the trend. Now, when price is above the 200, generally we're in an uptrend, and you can see that right here. when price is below the 200, generally we're in a downtrend. Now, we don't know how long the downtrend is going to be. We don't know anything like that. We just know if price is below, then we're, quote, air quotes here, generally in a downtrend. And this is why you never want to do things like, if you've ever landed on videos and things like that, like, oh, use the 200, just buy when price breaks below, and sell when price breaks below, buy when it breaks above. Well, there's a third thing that happens here, and that is when price is running through the 200, then it is generally more of a consolidated type market. Okay, so you can kind of see that right there. So we've got a move right here, we've got consolidation right here, and then breaks above, we got a move right there. So definitely only use this as sort of a reference point, but I actually want to teach you that's fine. Like, you can use it on the 15-minute like this. There's nothing wrong with it. Just kind of, okay, just getting a feel. Don't put a lot of stock into this. Don't be like, okay, price is just broken above the 200. We're in an uptrend. Because as you can see, right here, price broke above the 200. And look what happened. It just curved right over and went down. Right here, price broke above the 200, and then it just went right through. Right here, price broke above it, and then all it did is just consolidate and have a downward move. So I want to show you how I generally use the 200, okay? And I don't use it for everything or anything like that. It's just something that I got in my back pocket. It's just one of the little tools in the tool bag. And I think I can best show you that on a trade that I actually took. So let's go ahead and just find that trade real quick. It's actually right here. Okay. So when I was in these trades, on this trade, then I went ahead and I got out the 200 because it can often act as support and resistance. So I wanted to see if price was going to find some support here or if it was going to break through. And as you can see, what happened here, when I hover over this, it kind of takes away the candle color, unfortunately, but it paused right here, and then it consolidated for a few candles, and then it put in a big rejection wick closing below the 200. So that kind of gave me an indication, hey, listen, price is most likely going to continue downward. It didn't find a bunch of support on this level or anything like that. And so it gave me a little bit of confidence to stay inside the trade. I don't always use this. I'm not like, every time I get in a trade, I'm not like, okay, I got to pull the 200 out and see how things are going to shake out. No, but if I'm kind of like, I want to know what's going on in this area. Is this a possibility that price could turn around and things like that? Because don't take it as an end-all be-all thing, because there are plenty of times where price will come down here, find support on the 200, only to just have a little bit of a bounce and then fall through. So just use it as a reference point. Just test it out in your trading, and just see kind of if it is a benefit to you. And then for this trade right here, kind of did the same thing. Price came up, and then there was this big candle right here, but then I gave it one more candle, and we'll talk about that in the management section. And it basically just consolidated right around this 200, just consolidating before it had a drop. And this is where I trailed my stop. This is where I trailed my stop. And so you can use the 200 kind of like that, just kind of as like a little bit of a reference point for what's going on. I wouldn't make any big decisions off the 200. Here, if it found support and it was coming back off the 200, then that could be an indication to say, hey, listen, I'm going to go to half stop loss just to kind of cover myself a little bit, or I'm going to go to full stop loss, or anything like that. So that can be a good reference point for you. Okay, let's actually get back to today's trade right here. Okay. So the other way that you can use the 200 is when you're actually executing a trade on the 1 minute. If you see how it's running along right here, we've come down, price has ran into potential support area rejects it, and the 200 is just running right through here. Now, I didn't even have the 200 on when I took this trade. And I want to tell you that to emphasize that the things that I look for the most, the absolute most, is step one, key area, clean. Step two, price action validating a candlestick entry pattern. Okay, those are 99% of what's going on here. But this will line up sometimes, and it can give you added confluence. So it's something that I want to give you to put in your tool bag. Okay, so the 200 runs right through. The entry pattern is literally not only coming off the key area, but it's also coming off the 200 for additional confluence. And then, we've also got the 618 right here. So boom, that's a beautiful trade. And again, I didn't even have the fibs on this trade when I took it, okay? That's something that I did after I was already in the trade, after price was already like here. I grabbed the fibs and I ran it up, and then I saw, okay, great, that lines up. Definitely better to do that if you want to do that before you take the trade, but I didn't in this case. Okay, so we've gone over the fibs, the ways that you can use that. We've gone over the EMAs. Actually, I want to show you the other EMAs right here. So this is the 14 EMA, and this is the 50 EMA, okay? And that one, just so you can plot it in, is the 200 EMA. So other times, what you can do is just put on the 14 and the 50. And this essentially shows you when these cross. So when the 14, let's make sure that our 14 is the blue one. Yep, it is. When the 14 crosses the 50, then, air quotes again, we're in an uptrend. And then when the 14 crosses the 50 for the downside, okay, and they look like this, then air quotes, we're in a downtrend. But you know how that goes. It's not, price can consolidate back and forth and the lines can go, every which way and things like that. It's just used as a reference point. Now, the way that you can actually use this is really, I just don't even really use the 14, to be honest. It's not something that I really even utilize in my trading, but you can utilize the 50. Now, you can utilize the 14 and the 50, the 14 and the 50 right here to say, okay, hey, listen, we've got a cross, we're going up, I'm gonna, hold on to this trade until the EMAs cross. Okay, you can do things like that. You can see what works for you. I generally don't even really use them. I'll throw them on the chart every once in a while just to get a reference point. That's basically it. But the 50, now the 50 can really act as support and resistance, just like the 200. So, and it's interesting because the 50 is actually running right around here. It's not as nice as the 200 was for an entry on this trade, but it's just kind of right around this area. So let's go to one of the other trades. Let's see. Okay, and let's go to the 1 minute and let's slap it on. Okay, so for here, so when price breaks the 50, then it's, doing its downtrend. When it breaks the 50, it's doing its downtrend, consolidates right up just like it was with the 200. And then with the 15, I think this is probably where it may be utilized best or more accurately, that sometimes if price on the 15 kind of has a rejection towards the 50, then sometimes it follows that. I'm definitely not going to say it does it all the time or anything like that, but it can be put on there just as a reference point. I don't want you guys to have, I don't want your charts to be all messed up. Okay, I don't want your charts to look like they were bought at a secondhand store and they're filled with all of this, crap. I want you to just pop them on there for a reference point, use them if you need them, and then have your charts clean. Okay, there's something that you can just bring out if you want to take a look at them. So with the 50, I would say that Like for instance, this trade specifically right here, all the rejection that's happening, and then look what happened. It went up. Price broke, has a pull, acted as support. That's really all it is. It's all it is with EMAs is they can just act as forms of support and resistance. Sometimes they're strong, sometimes they're weak and they don't work out. So if you are taking a trade, for instance, and you see the 200 running through your point of entry, you see the 50 running through your point of entry, that could be added confluence for you that, okay, hey, sweet, this is the right area. There's definitely potential to launch here. Okay, so we've got the EMAs. I know a lot of people, they'll make a huge deal about these EMAs. They'll be like, buy at the green line, sell at the yellow line, don't touch it at the red line, sort of a thing. But I haven't seen that. I don't think that's a good way to trade. I think they should only be minimally used as a reference point. Okay, so then we've got our diagonal support and resistance, which is also known as a trend line. So with trend lines, this does not change our key areas, doesn't change our validation, does not change anything, okay? It just can potentially give us a little bit of confluence, and that's all we're looking for with our trend lines, okay? So with our trend lines, we're going to be utilizing them mostly on the 15-minute. We're going to utilize lines on the 1 minute, but they're not necessarily trend lines, and I'll go ahead and show you that. And basically what we're looking for here is we're looking for price to line up with a horizontal support or resistance level and basically make this little area that you see here. Let's do this, okay? So I kind of like to, I almost think of this as like a trampoline effect, where when price breaks and then it has its pullback, if it finds one of these places where, okay, it's come back to support horizontally, it's come back to support diagonally, then there can definitely be a momentum effect there where price can take off. And so the important thing is to get your trend lines correct, okay? We don't want to have to struggle and make things fit and things like that, because then we're just trying to make things happen. So right here, I want to show you something. So we need 2 points in order to create the trend line. So starting off, when we didn't know that this price action had even happened yet, and we're anticipating, then our trend line would look like this, okay? We're just going off the bottoms of these candles. We're running them through the wicks, a little bit of body right there, and then the body of these candles. What I'm trying to do is just get the trend line on as many points as I can, okay? I don't care if it's running through the wick. I don't care if this is not at the body. I would much rather, or the end of the wick. See, look at this. If I do that doesn't make sense, because we're not even taking into account where price has come right here and then moved away. So I'll scoot it up to the body. I'm completely fine with that, because it's giving me a more direct path of where price has actually used this area as support. And in this case, it's right here. So, if you're like, oh, should I draw it here? Should I draw it here? Should I draw it here? Draw it here, because in this place, you're taking into account the most amount of price action. You're taking this into account, this, and this, and this. So there's no need to, do this weird, funky stuff. Okay, so now, as price approaches this area, see how it looks a little bit different now? See how it's kind of dipped through? So what we can do is just adjust our trend line a little. We're not going to get it perfect, because it's not always going to line up, and it's not always going to line up perfectly. But then if we jump down here, and why did I adjust it? It's because, look, this wick came down before it pulled away and it acted as a level of support. So we're going to go ahead and plot that in. See, look, before any of that happened, it looks correct, doesn't it? It looks right. It's like, okay, maybe you can snug it up like a little bit more if you want to get closer to those bodies. Maybe you could have it like a little bit away like that or somewhere in the middle. It doesn't really matter. As long as we're not trying to force something to happen, it's completely fine. So we'll just kind of put that right there. And this is what happened. So you can see the rejection right around this area. Now, was there an entry here? There wasn't actually a valid entry here. There's no momentum reversal. There's no double bottom with a second point of valid entry, and there's no engulfing candlestick pattern that's going on here. Because remember, with the engulfing candlestick pattern, we want to see a bearish rundown and then an immediate engulfing candlestick. We don't want to see like, oh, price came down and then it kind of, I don't know, just hung out and consolidated a little bit, a couple rejection wicks, and then an engulfing candlestick. That's not what we're after. Okay, so you can kind of see how if this, was, let's say, a bearish rundown and then a nice engulfing candlestick right there, then that could be layered confluence that happened right there. And that's all we're after with this whole trend line thing. Sometimes they'll line up, sometimes they suck and they're not going to line up, and you can just totally, totally not even worry about it. Like, it doesn't matter. You don't have to get it to line up or anything like that. Now, in this case, so this would look like, and I really want to show you what it would look like beforehand so that when you're drawing them, you can be like, oh, okay, cool. Like, I can adjust it. It's not a big deal. So when it first happened, I would take into account the bodies and the wicks as much as I can every single time when it first happens. Then if price does something around here, and I have to adjust it a little bit away from a body or something like that, I'll go ahead and do it with no problem. Because what's important is what price is telling us. Price is telling us, hey, listen, this is the area of support currently that's happening. So I want to try to get that lined up with the trend line. If it's like way out here or something, if it's like way in here, I'm not going to go out of my way and try to force it or anything like that. But something like this, totally. And then instead of pulling it down here, I wouldn't do that because I want to take into account the bodies as much as I can. Think of it this way. If you can take into account the bodies, let me make this bigger, man. That was a little bit small. That's great. The wick is an area for you to be able to adjust back and forth as price gives you new areas to plot in, okay? Just like we just did. So this was actually a potential trading opportunity right there. And actually, let's grab the fibs. Let's see what happens. Okay, so the fibs don't line up. They line up at 38.2. And that's fine. You can, as you see more and more as you trade, and you actually get familiar with everything that's going on here, if you see price comes down to the 38.2 a lot for you and you're like, man, I am really not capitalizing on a lot of these trades because I'm waiting for the 618. Hey, there's no problem with that. You can change that and say, you know what? I like to use the fibs and really layer confluence with the 32.8 because that's what I see happen more often than not. That's beautiful, dude. Beautiful. Run with that. Run and roll with it. Okay. So let's see here. And there is a double bottom, but it doesn't have a second point of valid entry. So there's no entry on this trade, but as you can see, the confluence lines up really, really nicely. So let's build price out just a little bit and see if there is, okay, boom, look at that right there. And see, I want you to see something right here. So see how it touches these bodies, right? The wick right here and the body right here. And then what happens is it's already very close to this candlestick body and it's already has, several wicks running through and everything. That's fine. There's nothing for us to even do here. We can actually just keep the trend line as is. So let's kind of see what happened here. Okay, so there wouldn't have been any entry there because this doesn't completely engulf that candle, but it was very close. And again, you can see how the confluence lines up. So all we're doing here is we're just taking these wicks right here, running them through the body, and we could do it anyway. Like we could do it, this way. Actually, this way is probably, it actually is more correct because we're going through right to the bodies right there, okay? But it doesn't have to be absolutely perfect. It's still an area. It's just a tighter area than our horizontal support and resistance levels. Okay, so price comes down here, and it looks like, let's see, it does not give us a trading opportunity right there, but you can see the confluence. I'm just going to keep saying that. You can see the confluence. No trade, but you can see the confluence. Okay. And this is a tool that you can just have in your back pocket, man. And if you find a situation where it lines up, great. Kudos. You can totally use it. If you don't, then no sweat off your back. Okay, so right here, we've got a level right there. So let's see. So we would have this point and this point. Okay, let's do a little replay action. When I like to use this the most, really, is as price is walking up and you're just getting new level after new level after new level, and then you can get a trend line that lines up, then you will see those areas where it's just like doink, price comes there and then it just moves right off. So it definitely can be cool to add this to your trading when it fits. So let's go to this level was really created right here. So let's go to this area and see if there's a potential trading opportunity right there. Okay, and it looks like there is what we'll call, it's definitely not picture perfect, but there is a momentum reversal here. I would not take this momentum reversal because there's way too much wick on this side. And remember how we talked about it's fine if the doji has somewhat of a rejection wick, as long as it has wick on both ends. But then if it was like super long like this, then we wouldn't take it. So this is one that we just would not take that trade. So then we actually have a bullish engulfing candlestick pattern right here, still running through the key area, totally valid to take. We can go ahead and take that. Okay, so right there. So you can totally see how it lines up, just gives you that little boost of confidence. Your confidence should always come from the price action. These are just your fun little tools. Okay, so I hope that gives you kind of a little bit of a reference point about trend lines. Hopefully you can see how much they suck on their own. And how you can pull it out and use it, and every once in a great while, then it will line up and it'll be like, oh man, this is sweet. Okay, so follow the momentum. This is what I was talking about a little bit earlier that I want to show you guys, and it is reading price action intently, okay, and understanding the momentum. So when I say momentum, I'm just talking about when price, like for instance, when price breaks here and it comes back and retests this area, you and me, we're ideally thinking, okay, well, if price comes back here, potentially it's going to move away. It's going to gain steam. That's all I'm talking about when I say momentum. I'm just saying price is moving this way, price is moving that way, okay? And it's like picking the momentum up. So see how it has to come back. Why didn't it just take off here? Like, why didn't it just keep going? Because it needed to pick up momentum. It's like when you're running a marathon or you're doing a 5K, probably not a 5K, but there's like a snack booth, and you like grab your water, you grab your like granola or whatever, and you keep going, and it just kind of gives you a little bit of a momentum boost. It's the exact same thing here. So price is coming back, picking up some energy, and then it's expending that energy in the direction that it continues. Okay, so I want to jump down to the 1 minute, and I want to talk about that. And I also want to talk about how you can utilize things like channels like this to see how price is moving. Okay, I don't want you to get into the mindset, and I don't think you will, that, you know, hey, I got this channel, you know, and I'm a channel trader, and, you know, I'm trading the channel and things like that. That's not what I want you to do. I want you to utilize things like channels just to see how price is moving more clearly. Okay. And so the reason why I have this up here is because it just helped me see, okay, you know, price is making lower price points. It's not pushing up, and it's just trickling back down to this key area. Where price is pushed deeper into the key area right here. It hasn't really gone any further. And then when it comes here, it's pushed even less. So when price comes here, do you think that we're going to be really keen to take a trade? Probably not. Probably not, unless we're being really aggressive and we're okay with, you know, hey, listen, this could turn into a loss and that sort of a thing. I want to make this super duper clear, so I took both these screens and I put them one right here and one right next to the other one. So I'll go ahead and switch back and forth. But right here, we got our first touch, right? And right here, we have got our first touch, because this is very, very close. I would consider this going into the key area. Okay, so then we've got our dramatic move away, and we've got our not as dramatic move away, but still not a consolidatory move like this. Okay, then we've got our second touch. What happens? Price breaks a little bit. I wouldn't really say that it breaks, but it does something. Okay, it does a little something. We've got our second touch. Price does a little something, right? It actually does break this area a little bit, but look what happens here. Pushes deeper into the key area, and then it shows us a sign of life by gaining more momentum than the previous touch out of the key area. Look. Okay, pushes into the key area again, and it just doesn't show us anything. Like, it doesn't show us, look, I mean, it doesn't break anything, it doesn't do anything. Then when it comes to the potential trading opportunity, because I saw this move happen and there's potential momentum here, I'm in the trade. Whereas when it comes back, here we go, where it comes back to the key area and gives me an entry, I'm too hesitant about it, man. It's just, there's not enough that has happened, and there's not enough signs of momentum for me. Whereas with this one, there is, okay? There is enough signs of momentum that something's going on. We've got one, we've got two, and this one proved that it's going further than the previous one. This one right here, it may have broken a little bit of structure and had a little move, but look, then next time it comes up, nothing there. So I'm not taking the trade. So we got 1, 2, 3, 4 touches, 1, 2, 3, 4 touches, okay? So I really want you to understand that. We'll go through, you know, more examples and things like that. Actually, you can just go through more examples in your own chart. I mean, it's the same thing over and over and over again. It's just price is coming. If it's sharp and it comes back, sharp move away. Okay, if it's very consolidating and things like that, then you just want to start looking for signs like, hey, is price really going to have the momentum to come out of here? Because sometimes it will. Sometimes it will have that momentum and it'll create a great move. Other times, if you're just not seeing the signs of life, okay, you know, here's the move, comes back, not a real strong move, and then on the third time, it basically really convinces me like, this is just not, it's not even worth it here. It's not even worth it. But then this one, you know, okay, here's the first one, you know, a little skeptical. Here, then here's this one. Oh, okay, well, hey, we've broke past that point. Right here, we got a move. Right here, nothing to show for it. Right here, we got a move, still on the fence. Right here, we got a little something to show for it, okay? So I really hope that that makes sense, but those are really the nuances of reading price. And don't feel like you have to be like, oh my God, I have to read all this price. I don't understand where the break should be. I don't understand where price should be. I just want you to relax, take it easy. This happens with time. This is a long game. But you know what you can do in the short run? Just study it. Just study it with your own eyes. See what you find. See what pops out to you. And then look for really obvious places to take trades, okay? That's going to wrap up Layering Confluence. That's really all you need. And again, I take most of my trades without ever using fibs, without ever using EMAs, without ever using trend lines or anything like that. And honestly, most of the trades that I take, they don't even have to do. I'm not even dealing with this all the time. Okay, don't think this is something you'll find on every trade. There's plenty of trades that I take where it literally, comes up, breaks, retests, good, ready to go. But this is an important skill to develop. Just look at the price and look at what it is telling you.